Hello, everyone, and welcome back to Boni's Life, your home for the most in-depth and unfiltered analysis of the crypto universe. If you're tired of the hype and looking for real, actionable insights that can help you navigate these volatile markets, you've come to the right place. This is where we cut through the noise and give you the unvarnished truth. Today, we're dissecting the chaotic roller coaster month of February 2025, a month that tested the conviction of even the most seasoned crypto veterans. We saw a brutal sell-off, a record-breaking hack, and a memecoin apocalypse, but we also witnessed the quiet, relentless advance of institutional adoption and a surprising regulatory thaw. So, was February a catastrophic setback or a necessary correction before the next explosive move higher? By the end of this episode, you'll have a crystal clear picture of what really happened, why it happened, and what it means for your portfolio. We're going to break down the technicals, dissect the fundamentals, and even calculate what a $100 investment would have yielded. And trust me, you're not going to get this level of analysis anywhere else. So buckle up because we're about to go deep. February 2025 will be remembered as a month of reckoning for the crypto markets. After a euphoric start to the year, with Bitcoin flirting with the $109,000 mark in January-February, brought a harsh dose of reality. The total cryptocurrency market capitalization, which had peaked at a staggering $3.76 trillion, took a nosedive, plunging below the $3 trillion level by the end of the month. This wasn't just a minor dip, it was a significant market-wide contraction that sent shockwaves through the industry. Bitcoin, the king of crypto, bore the brunt of the sell-off. It plummeted from its January highs, briefly crashing below the critical $80,000 support level, before staging a modest recovery to close the month at around $84,000. That's a painful 17.5% drop for the month and a staggering 28% correction from its peak. If you were holding Bitcoin, you felt that. But as bad as that was, Ethereum and the altcoin market had it even worse. Ethereum, which had been trading at nearly $3,300, saw its price collapse by a gut-wrenching 33%, bottoming out around the $2,200 mark. This brutal price action was a stark reminder of the inherent volatility of this asset class and the unforgiving nature of the crypto markets. The fear and greed index was flashing extreme fear, and social media was a firestorm of panic and despair. But as we'll see, the headline numbers only tell part of the story. Beneath the surface of this sea of red, powerful undercurrents were at play, setting the stage for the next chapter in crypto's evolution. So, what was the catalyst for this brutal February sell-off? It wasn't just one thing, but a perfect storm of macroeconomic headwinds, a catastrophic exchange hack, and a speculative bubble bursting in the memecoin sector. Let's start with the macro picture. The global markets were on edge, spooked by the Trump administration's announcement of a proposed 25% tariff on all imports from Canada, Mexico, China, and the European Union. This protectionist rhetoric sent a chill through the global economy, and we saw a classic flight to safety. The US dollar strengthened, and safe haven assets like US Treasuries rallied, sending yields to two-month lows. This risk-off sentiment was a major headwind for speculative assets like crypto. Adding to the gloom, consumer confidence in the United States slumped to near multi-decade lows, and the ISM services sector contracted for the first time in over 2 years, signaling a potential slowdown in the world's largest economy. This was the backdrop against which the crypto market was operating, and it was an unforgiving one. Then came the bombshell, the Bybit hack. On February 20th, news broke that Bybit, the world's second-largest crypto exchange, had been hacked for a staggering $1.5 billion worth of Ethereum. This wasn't just another hack, it was the largest single theft in the history of cryptocurrency. The scale of the breach was breathtaking, and it sent a shockwave of fear and uncertainty through the market. The hack, which was later attributed to the notorious Lazarus Group, exposed the vulnerabilities of centralized exchanges and shook investor confidence to its core. The market's reaction was surprisingly delayed, but when it came, it was brutal. The news of the hack, combined with the already fragile macroeconomic environment, created a toxic cocktail that sent prices spiraling downwards. It was a stark reminder that in the world of crypto, security is paramount, and the failure to protect user assets can have devastating consequences for the entire ecosystem. As if the macro fears and the Bybit hack weren't enough, February also witnessed the spectacular collapse of the memecoin bubble. After a period of insane speculation-fueled rallies, the memecoin sector, which had been the darling of the market in January, came crashing back down to earth. The sector as a whole plummeted by a staggering 41%, with many of the most popular tokens losing the vast majority of their value. The collapse was fueled by widespread accusations of insider trading, pump and dump schemes, and outright fraud. The controversial launches of tokens like Dollar Trump and Dollar Melania in January were followed by the even more audacious launch of Dollar Libra, a token linked to Argentinian President Javier Milei, which briefly reached a mind-boggling $4 billion valuation before crashing by over 98%. The fallout from the memecoin collapse was significant. It not only wiped out billions of dollars in speculative capital, but also cast a dark shadow over the entire crypto space, reinforcing the narrative that the industry is rife with scams and manipulation. The on-chain data tells the story. Gas usage for memecoin trading on Ethereum and Solana plummeted by 73% and 65% respectively, as the speculative frenzy evaporated, leaving a trail of wrecked portfolios and shattered dreams in its wake. Now, let's get technical and break down the price action for Bitcoin and Ethereum in February. For Bitcoin, the key levels to watch were the support at $90,000 and the major support at $80,000. The price repeatedly tested the $90,000 level, and for a while, it held strong. However, the relentless selling pressure eventually broke through, sending the price down to the $80,000 support, which thankfully held. On the upside, the resistance levels at $100,000 and $110,000 proved to be impenetrable walls of selling pressure. From a pattern perspective, we saw the formation of a falling wedge, which is typically a bullish reversal pattern. This suggests that despite the sell-off, the underlying structure of the market was not entirely bearish. However, the moving averages on the 4-hour time frame were flashing strong sell signals, and the price had broken below the 200-day moving average, confirming a short-term downtrend. The RSI, Relative Strength Index, had reached its lowest levels since August 2023, indicating that the market was deeply oversold. The monthly MACD, Moving Average Convergence Divergence, had also crossed into bearish territory, suggesting that the longer-term trend was weakening. The declining volume during the sell-off was a silver lining, as it indicated that the selling pressure was not as strong as the price action might suggest. In short, the technical picture for Bitcoin was a mixed bag, with bearish short-term signals but some underlying signs of potential reversal. For Ethereum, the technical picture was similarly complex. The key support level was the $2,200 area, which was tested and held during the February crash. On the upside, the resistance levels to watch were $2,785 and the $2,100 to $2,200 range. We saw the formation of a symmetric triangle on the 4-hour time frame, which suggested a period of consolidation and a potential bullish bias. On the 1-hour time frame, an ascending triangle was forming, which is another bullish pattern that often leads to a breakout to the upside. After finding key support at $1,380, Ethereum entered a period of bullish consolidation, suggesting that the worst of the selling might be over. The price action was incredibly volatile, especially around February 7th, with sharp fluctuations that shook out both long and short positions. Like Bitcoin, Ethereum also formed a falling wedge pattern, which is a bullish reversal signal. The technical setup for Ethereum, while still bearish in the short term, was showing some promising signs of a potential recovery. Looking at the broader market, one of the most interesting technical developments in February was the decoupling of Bitcoin from the Nasdaq. The correlation between Bitcoin and the Nasdaq, which had been as high as 0.8 in 2022, dropped to just 0.27. This is a significant development, as it suggests that Bitcoin is increasingly moving to its own rhythm, independent of the traditional financial markets. This is a sign of a maturing asset class and a potential indicator that Bitcoin is starting to be seen as a true safe haven asset. However, the market was still vulnerable to liquidation cascades, where the breaking of key support levels triggers a wave of forced selling exacerbating the downward price movement. The volume profile during the recovery attempts was also a cause for concern, as the low volume indicated weak buying pressure. The market structure of lower highs and lower lows was still intact, confirming the short-term bearish trend. So, while there were some glimmers of hope on the technical front, the market was not out of the woods yet. Now, let's shift our focus to the fundamentals, because this is where the story of February gets really interesting. While the price action was a bloodbath, the underlying fundamentals of the crypto market were actually strengthening. Let's start with Bitcoin. On the institutional adoption front, we saw some major players making significant moves. BlackRock, the world's largest asset manager, added a 1 to 2% Bitcoin exposure to its $150 billion model portfolios, a move that puts Bitcoin in front of thousands of financial advisors and wealth managers. This is a massive vote of confidence from the heart of the traditional financial system. MicroStrategy, the publicly traded company with the largest Bitcoin treasury, raised another $700 million through a perpetual preferred stock offering, which it will likely use to buy even more Bitcoin. And it wasn't just corporations, sovereign wealth funds are also getting in on the action. Abu Dhabi's Mubadala Sovereign Wealth Fund disclosed a $436.9 million stake in BlackRock's Bitcoin ETP. At the state level, the Wisconsin Investment Board increased its Bitcoin ETF holdings to over 6 million shares, a position worth over $321 million. And in Europe, the governor of the Czech Central Bank publicly advocated for evaluating Bitcoin as a reserve asset, suggesting a potential allocation of up to 5%. These are not small players. These are major institutions with long-term investment horizons, and they are accumulating Bitcoin at an accelerating pace. This is the smart money, and they are not fazed by short-term price volatility. On the Ethereum front, the fundamentals were equally compelling. Despite the price crash, the network's fundamentals remained incredibly strong. The DeFi, decentralized finance, ecosystem, which is largely built on Ethereum, continued to grow, with the total value locked, TVL, exceeding $200 billion. Developer activity remained high, with a steady stream of new smart contracts being deployed on the network. The institutional interest in Ethereum was also growing, with former President Trump even including it in his proposed U.S. crypto strategic reserve. The stablecoin ecosystem, which is a key pillar of the DeFi space, also saw significant growth. The VanEck-backed stablecoin AUSD surpassed $100 million in assets under management and launched on its sixth blockchain. Figure, a new player in the space, launched the first retail yield-bearing stablecoin, bringing traditional financial yield mechanisms to the world of crypto. The Bybit hack was a major setback for Ethereum as it exposed the security risks of the ecosystem. However, the network itself proved to be incredibly resilient, and the incident served as a wake-up call for the industry to double down on security and best practices. Looking at the broader crypto ecosystem, the fundamental trends were overwhelmingly positive. Stablecoins now account for 30% of all crypto transaction volume, a testament to their growing utility as a medium of exchange and a store of value. The regulatory environment in the United States also saw a surprising and dramatic improvement. The SEC, which had been on a warpath against the crypto industry, abruptly dropped its cases against major players like Coinbase, Uniswap, Robinhood, and Binance. This regulatory thaw, combined with a new House draft bill that removes many of the federal restrictions on stablecoins, was a major victory for the industry. The narrative is shifting from one of excitement-led speculation to one of infrastructure-led utility and long-term capital alignment. The data on global crypto adoption is also incredibly bullish, with India and the United States leading the way. The DeFi ecosystem continues to show fundamental strength, and the collapse of the memecoin bubble, while painful for some, was a healthy cleansing of the speculative excess that had been building up in the market. In short, while the price action in February was ugly, the fundamental picture was one of growing strength, resilience, and maturity. So with all that said, let's talk about the bottom line. If you had invested $100 in the crypto market at the beginning of February, how would you have fared? Well, it depends on what you bought. If you had put your $100 into Bitcoin on February 1st, when the price was around $104,914, and held on until the end of the month when the price was around $84,000, you would have ended up with about $80.10. That's a loss of nearly 20%. If you had invested in Ethereum, your losses would have been even steeper. A $100 investment in Ethereum at the beginning of the month, when the price was around $3,298, would have been worth just $67.80 by the end of the month, a painful loss of over 32%. The altcoin market was a sea of red, with some of the worst performing sectors being memecoins, which were down 41%, oracles which were down 36%, and gaming which was down 35%. A $100 investment in any of these sectors would have resulted in a significant loss. But it wasn't all doom and gloom. There were a few bright spots in the market. The best performing major altcoin in February was Sonic S, which bucked the trend and rallied by an impressive 21%. A $100 investment in Sonic at the beginning of the month would have grown to $121 by the end of the month, a handsome return in an otherwise brutal market. This highlights the importance of diversification and the potential for outsized returns in the altcoin market, even during a market-wide downturn. The key takeaway here is that February was a month that rewarded patience, discipline, and a deep understanding of the market. Those who panic sold at the bottom locked in their losses, while those who held on or even bought the dip were well positioned for the eventual recovery. So, what can we conclude from the wild ride that was February 2025? It was a month of extreme volatility, a month that separated the tourists from the true believers. The brutal sell-off was a painful but necessary correction, a classic bull market shakeout that flushed out the weak hands and the speculative excess. The Bybit hack was a stark reminder of the security risks that still exist in this nascent industry, but it also served as a catalyst for improvement and a renewed focus on best practices. The memecoin collapse was a much-needed cleansing of the speculative froth that had been building up in the market. But beneath the surface of this chaos, the fundamental trends were incredibly bullish. Institutional adoption is accelerating, the regulatory environment is improving, and the technology is continuing to mature. The decoupling of Bitcoin from the traditional markets is a major milestone, and the growing utility of stablecoins and DeFi is a testament to the real-world value that is being created in this space. So, was February a disaster? I don't think so. I think it was a stress test, a trial by fire that the crypto market passed with flying colors. The fact that the market was able to absorb a $1.5 billion hack and a major macroeconomic shock without completely collapsing is a testament to its growing resilience. The historical data also provides some comfort. In the 2017 bull market, we saw multiple 30 to 40% corrections before the market went on to make new all-time highs. In 2021, we saw a 55% correction before the next leg up. The February 2025 sell-off fits this pattern perfectly. It was a classic bull market correction, a healthy reset before the next major move higher. The smart money knows this, and that's why they were buying while everyone else was panic selling. The future of crypto is brighter than ever, and those who have the courage and the conviction to stay the course will be richly rewarded. That's all the time we have for today. I hope you found this deep dive into the February 2025 crypto market to be valuable. If you did, please do me a favor and hit that like button. Subscribe to the channel and ring that notification bell so you don't miss our future episodes. And I want to hear from you. What are your thoughts on the February sell-off? Are you bullish or bearish on the future of crypto? Let me know in the comments below. I read every single one of them. Thanks for watching, and I'll see you in the next episode of Boni's Life. Stay strong, stay informed, and stay profitable.